Hey everyone, Alex here with Morgan. The bell has rung, the tape is in. Let's break down what actually happened today versus what we thought this morning.
Let's do it.
The regime today was really a paradox. We came in this morning saying it was all about CPI, and CPI...
And it was, but not in the way anyone expected.
Not at all. We got a massive deflationary signal from that CPI print, yet the bond market sold off hard and the curve steepened. The market is basically screaming at us.
It's screaming that bad news is no longer good news for liquidity. This feels, I don't know, more like a growth scare. The whole dynamic has shifted.
It really has. Let's get to the closing snapshot, because the numbers tell the story. I'm looking at the equities, and it's almost deceptive.
Deceptively calm on the surface.
Exactly. SPY finished basically flat, up just 0.07% at 682.54. The Qs, QQQ, underperformed, down about 0.25%.
And small caps were also just flat to down, nothing dramatic in the indices.
But under the hood, look at gold. GLD got liquidated, down over 3%. And even crypto was weak. Bitcoin down almost 2%. This wasn't a risk-on day.
No, the real engine of today's move was absolutely in the bond market. That's where the chaos was.
So walk us through the rates.
Okay, so the 2-year yield is sitting at 3.40%, but the 10-year, that's the one to watch. It pushed all the way up to 4.04%.
So the spread, the 10-2 spread, is now at plus 64 basis points. The curve is definitely steepening.
It is, but this morning we were flagging that a steepening curve could be a reflation signal, and I think we need to be really careful with that word today.
Right. How can it be a reflation trade when the main inflation print of the day was a massive deflationary miss?
It can't be. This isn't your standard growth-driven reflation. I think what the market is pricing in is a risk premium, aka a term premium at the long end. It's almost like it's losing faith.
Losing faith that the Fed can cut fast enough to stop the rot, maybe?
That's one interpretation. The other is that there's just so much duration supply coming. Either way, the price of long-term money is going up, even as the economy is screaming slowdown. And that's a scary setup.
It's a very scary setup. Let's dig into that macro driver. The 10:15 a.m. data point was the moment everything changed.
That was the catalyst.
Inflation rate, month over month, for January, came in at negative 1.7%. The estimate was for a positive 0.5%.
That's not even in the same universe as the estimate. That's a severe deflationary signal.
And it hit everything immediately. The front-end rates, the dollar, gold, you could see the vol surface just explode.
And what's interesting is just before that at 10 a.m., the sentiment data sort of set the stage. It was already weak.
Right, so we got the ZEW economic sentiment, which missed estimates. Then the broader economic sentiment also came in way below expectations.
So the soft data, the sentiment, was already telling you things were slowing down. And then the hard data, CPI, didn't just confirm it, it shouted it.
Which brings us back to that core contradiction. All the data is soft, deflationary even, yet the yield curve steepens. So what happened to bad news is good news?
I think the regime is dead. Bad news is now just bad news. A sign of growth concerns, not a signal for more liquidity from the Fed. That's the big takeaway.
Okay, so if that's the macro picture, let's talk about the internal mechanics. The VIX, the fear gauge, is interesting. It's holding above 20.
Yeah, it's not at panic levels, it's not at 30, but it's on alert. But I don't think you can look at the VIX in a vacuum today.
You think this is really about the bond market?
I think bond vol is bleeding into equity vol. The spread between VIX and historical vol is really wide, plus 6 percentage points.
Which tells us what?
It tells us institutions are actively and expensively paying up for protection. They're hedging, and I think they're hedging because they have no idea where the 10-year yield is going to settle. The uncertainty isn't about earnings next quarter. It's about the cost of capital itself.
And that hedging shows up in the flows, right? Look at the put-to-call ratio.
1.24. That is what our system tags as extreme bearish. It's a huge number.
So heavy put buying across the board. SPY, QQQ, IWM, everyone is bracing for a drop.
Exactly. And you can see where the money is hiding. We track these factor rotations very closely, and the signal is crystal clear.
This is the defensive versus momentum trade.
Over the last 5 days, the defensive factor is up over 1.5%. Meanwhile, the momentum factor is down more than 0.5%. That's a huge divergence. The market isn't speculating, it is hiding in safety.
Which makes a lot of sense. You don't buy high flyers when you're worried the bond market is breaking.
You buy what you think will still be standing if things get worse.
So with that in mind, let's look at some of the single-name movers because there were some wild ones. But I think we need to be careful to separate the signal from the noise.
Yeah, a lot of noise today.
On the upside, you had Massimo, ticker MASI, up 34%. That's a clear legal or regulatory catalyst, some shareholder activism news.
Then you had Compass Pathways, CMPS, up over 30%. Also a clear catalyst, some positive FTA-related news. Those make sense. They're idiosyncratic stories.
Exactly. But then you see a name like Atara, ATOM, up almost 46% with absolutely no confirmed catalyst. To me, in this environment, that's not a signal.
No, that's noise. That's a liquidity gap or some retail frenzy. It tells you nothing about the broader market. And trying to chase it is a good way to get hurt.
Right. The real story isn't the one-off speculative pop. It's that broader rotation into defensive names that we just talked about. That's the institutional move.
That is the real flow.
Okay, so let's update the watch list. What are the key levels and instruments we need to be watching into tomorrow?
Well, number one has to be QQQ. It's now down over 5.5% from its 20-day high. The pressure from higher rates is really starting to bite there.
So the key question is whether the selling pressure continues or if we get some kind of bounce at the open.
And that will depend entirely on what bonds do. So TLT is the other side of that coin. It was actually up slightly today, which is interesting.
A flight to the really long end of the curve, maybe.
Maybe. We need to see if that extends. But I want to touch on one of the more technical sensitivities we're watching. It's a bit in the weeds, but it's important.
Go for it.
We're looking at the 5-year forward inflation expectation rate.
Okay, so what the market thinks inflation will be 5 years from now for the 5 years after that, the long-term view.
Exactly. And it has collapsed. It's sitting at 2.12%, which is only the 7th percentile over the last year.
Wow. So what does that mean in plain English?
It means the bond market isn't just seeing a temporary soft patch. It's starting to price in the risk of a potential deflationary lost decade.
That is a powerful thought and a huge warning signal.
It completely changes the investment landscape if it proves true. It tells you the market is much, much more worried about deflation than inflation right now, despite the Fed's narrative.
Okay, so let's put it all together and look ahead. What's the setup for tomorrow? What's the immediate catalyst?
Well, tonight, late, at 11:50 p.m. Eastern, we get exports data. That could have an impact on the dollar and any trade-sensitive stocks.
And what about sympathy plays at the open? Anything to watch?
I'd keep an eye on the big semi-names like QCOM and AMD. There's been a lot of news flow around their bigger peers like Apple and Nvidia.
So potential for some read-throughs there.
Potentially. But we have to remember the hierarchy here. In this environment, the macro gravity is just immense.
So rates first, everything else second.
Exactly. It doesn't matter what good news Qualcomm reports that the 10-year yield is ripping past 405. Duration pressure will crush that sector sympathy. Watch the yields first, then the tech news.
That's the playbook. Which brings us to the final decision point for tomorrow. What is the one question we need answered?
It's simple. Does the 10-year yield hold above 4%? If it does, then today's defensive rotation, the pressure on tech, all of that likely continues.
And if it pulls back below 4%?
Then you could see a sharp tactical squeeze in some of those beaten-down tech names. But the direction of the 10-year is the key. That's the tell for tomorrow. That's your end-of-day wrap. We'll be back before the bell tomorrow. Morgan out.